Hello, I'm Sam Stovall, U.S. Equity Strategist for S&P Capital IQ. In this week's Investment Policy Committee meeting notes, we discussed jobs, inflation, and the timing of a new rate tightening cycle. We think the risk of a June rate hike increased following the much better than expected February jobs report. In addition, the data point to the likely removal of the word patient from the March 18th policy statement. Yet a mid-2015 hike still isn't a done deal in our opinion, as some vital components to the FOMC's calculus are still underperforming, namely labor force participation as well as wage and price gains. Janet Yellen indicated in her Humphrey Hawkins testimony that the Fed needs to see hard data to be confident that the improvement in the labor market is broad-based and that inflation is trending toward their 2% target. The Fed probably won't have those statistics solidly in place by June. What's more, history hints that the Fed may even wait until inflation moves above the 2% level, as both headline and core personal consumption expenditures, or PCE levels, averaged 3.2% at the start of the last 13 rate tightening cycles since the late 1940s. In addition, Ms. Yellen stressed that the Fed doesn't want to choke off the recovery too soon and emphasized that removing the word patient would not mean that a liftoff is imminent. While we still believe the Fed will start its rate tightening cycle in June, we understand why they may wait just a little bit longer. I'm Sam Stovall, and I'll talk with you again next week.